Welcome to Mad Money. Welcome to Cramerica. Other people and friends, I'm just trying to make a little bit of money. My job is not just to entertain, but to educate you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Whew. We made it through October without a crisis or a nasty decline. And I, for one, am shocked. Today, like so many other days this month, after a higher opening, it looked like we were going to get clocked. But then the market found its footing, strangely, with the Dow finishing up 41 points as it began gaining 0.26%, the NASDAQ jumping 0.61%. Oh, it was a strange one, though. We had not one, but two terrific upside surprises from last night, Apple and Amazon, but only one resonated. Amazon stock shot up nearly 10% to an all-time high. But Apple opened strong and then gave up all its gains. The gigantic tech nation states that reported this week, which, by the way, include Meta, Microsoft, and Alphabet, overall acquitted themselves quite poorly. Only Alphabet really did well, with the worst being Meta, down more than 100 points in 2 days. Even though Meta is doing terrifically, Wall Street doesn't like that Mark Zuckerberg wants to spend a fortune to fend off his AI competitors. More on that later. It's interesting. Amazon actually was quite frugal, and people like that. For now, you just need to know that even though I'm a big believer in AI as the fourth industrial revolution, Wall Street's gotten skeptical of all of this capital spending. I still think these stocks are worth owning, and great stocks are the best defense in any tough market, as long as you own them as part of a diversified portfolio. Like I say in How to Make Money in Any Market, you should own one or two of these and trust them. Own them long term, though. Do not try to go in and out and in and out. It's all your call. But we encourage long-term investing in Cramerica, and that's how you make a real fortune in stocks. Now, look, I understand it is a tempestuous time. Lots of companies that serve the consumer have gotten very, very weak, in part because of inflation, in part because of the now endless government shutdown, and in part because of people getting worried about AI taking away their jobs. Still, I think you got to have the long-term view here. We're in the middle of earnings season, just finished the biggest week, and we come out relatively unscathed. More important, we made it out of October without some sort of collapse. Historically, we dodged a real bullet. So let's see what the first week of November has in store for us. Now, we don't have to wait until Monday for some important news. We get Berkshire Hathaway's earnings tomorrow morning. And apparently there will no longer be any commentary from the greatest investor of all time, Warren Buffett, who's retiring as CEO. The 95-year-old Buffett has agreed to turn the company over to a fabulous exec, Greg Abel, who will take the reins at the stock at year-end. The stock's been getting clobbered here, though. I presume that's because of the changeover. Now, look, you got to understand, I think Berkshire's a terrific company, and you have to expect more profit-taking as Buffett leaves. But what can I say? He is irreplaceable, but the company's a great one. Monday at the close, we hear from a company that may be, and this is a little hyperbole, the next Berkshire Hathaway. All right, I'm talking about Palantir, run by the brilliant Alex Karp. I know, presumptuous and heretical of me, but I am just reporting on the narrative as I keep hearing it from so many people. Palantir is obviously nothing like Berkshire, but people worship Karp. They do. And they like to think he is the Buffett of what he does, and he does run an amazing consulting and advisory company. When Palantir stock was at 50, I said it would go to 100. When it got to 100, I said it would go to 150. And when it got to 200 this week, I said it's headed to 250. After this run, I do expect some profit taking in the quarter, but I'm not backing away from this one long term. Why? It is just too good to ignore. And it's clients whom I've checked in with, multitudinous. They love them. Now, we also hear from Clorox, quite different from Palantir, with a stock that is down more than 30% for the year. Clorox is at the heart of this market's conundrum. In the old days when we had worries about the economy, everybody bought the consumer packaged goods stocks. Now, perhaps because of inflation, people just won't pay up for the name brands. Let's see what CEO Linda Rendell has to say. Now, will Pfizer break out from the $25 level? Oh, it's been a dull run for this former growth drug stock, as shareholders seem to be satisfied with a 7% yield, not much price appreciation. I like growth, but that dividend seems safe and is backed up by cash flow. On Tuesday morning, we'll find out if Pfizer is going to be more of a stock and less of a bond equivalent. Shopify turns in its numbers Tuesday. This is a good one. Canadian, terrific. It's become a very reliable winner. I think it can duplicate. It's an e-commerce champion that has a great way to work with small, medium-sized businesses. Hey, by the way, I feel the same way about Uber doing well. Another company that's fulfilling its grand ambitions. After the close, we have two huge winners so far this year. Well, one for many, many years. Well, actually, both of them, really, AMD and Axon. Now, we've had their CEOs on repeatedly. These are the kinds of long-term outperformers that you simply have to consider owning. Lisa Su at AMD is challenging NVIDIA at its own game. Axon's upending the entire law enforcement paradigm with its tasers, its body cameras, its drones, and its automatic artificial intelligence-driven police reports. You know what? I actually own them both. Not for the screamers, though. Caterpillar's become one of the best performers in the entire market, and I think that move is justified, given how so much of their equipment is used to make and maintain data centers. The company holds an analyst meeting Tuesday. I want to know if this move is multi-year in nature. I have to tell you, spoiler alert, I think it is. Oh, and please don't forget to vote. It's your civic duty. Now, on to something more interesting. McDonald's reports on Wednesday, and I think they are the single best judge, maybe in the world, of the true state of the consumer who is strapped, who is worried. Alongside, by the way, restaurant brands, Burger King, which is on the show tonight. We keep hearing about this cash-strapped consumer not willing to eat out and wants to stay at home, wants to preserve capital. But only McDonald's and Burger King can really tell us if that's true or if these people have decided that tastes have changed. Robinhood reports after the close, and this online brokerage has managed to win over millions of investors, maybe you. It's become the bell cow of this rally. And I am betting we get some fantastic numbers. Now, it's tough to get data without a government, with this government shutdown, right? But you know who has the best? I think Bank of America does. And it holds an analyst meeting on Wednesday. We're going to find out more about the consumer from them than anybody else. I think it'll tell a relatively sanguine story about the state of the economy and the bank, and it could be uplifting. It's a very inexpensive stock. Next, what the heck is really going on with this Warner Brothers discovery? Is the company going to sell itself to the highest bidder? Are the earnings any good? That's Thursday's business before the open. And I want to see if there's going to be an auction. To me, the stock's moved into arbitrage levels, meaning it's up a ton in anticipation of a takeover, but I think you could still catch a couple more bucks if they close any sort of deal. Of course, if they don't, though, like arbitrage, look out below. We got a couple real good ones lumped in here today. We got a firm for buy now, pay later, SanDisk for tech storage, and MP Materials for rare earth materials. All three have had tremendous stories to tell for a while now, although SanDisk has had a huge and now parabolic run, and I don't like to recommend the ones that are in parabola mode. Finally, Friday, we got a lagging fast food chain, Wendy's, and one of the best performers of the year, Constellation Energy. The company generates power, including a lot of clean nuclear energy. I think these two bookends are most appropriate. Winners win, so you continue to buy Constellation, and unfortunately, losers keep losing, so you got to avoid Wendy's, but especially, by the way, when we have the superior restaurant brands coming up later in the show. The bottom line, I can't tell you not to be glum. I can tell you that the year of magical investing is not yet over. It's taking a breather. But we did get through the historically tough months of September and October with no break in the magic. If the past is any guide, November and December tend to be much, much better. Let's go to Jerry in Illinois. Jerry.
Hey, Jim, your mission has been very successful in our family. About 10 years ago, maybe more, maybe less, you told us to keep an eye on and to turn our attention to our children and grandchildren. So here's what we did. We opened up 4 custodial accounts, gave each kid $100, and we said whatever they earned in the summer or their after-school work, we would match dollar for dollar, only in stocks. 2 for 1, by the way. Well, it's 7 years later, and you're really not going to believe how much money. Well, I don't want to tell you because you won't believe me. But there's something else that happened. We made 4 lifetime investors. They call us and ask questions, and when they do, I make them do some research. So one of the kids came up with something about a year ago called MNTN, which is really my question. I couldn't figure it out. I didn't know what it was, but they loved it so much. I bought each of them 25 shares, then bought 25 shares for myself. So I follow it, and I can't figure out what's going on. Can you help me?
I can't either. I think it's a better company than it's trading. I know we spoke to them earlier today. I do believe that MNTN offers a great opportunity for advertisers. Let's just step back for a second, though, and think about what you've accomplished. You have made it so that people's lives have changed. I'd like to think I played a role in that. You're kind enough to share with me. MNTN so far has not worked out. I was telling Ben Stoder earlier today, I am surprised myself that it's not doing better. they're not delivering. And that's just unacceptable. Okay. The year of magical investing is not over. It just took a breather after a couple of historically tough months. And if the past is any guide, November and December, they do tend to be much better. Well, Mad Money tonight. Every day I feel like we've got another story about how the consumer's pulling back from spending on restaurants. So where does the company like Restaurant Brands International fit in the equation? I'm checking in with the company's top brands. Then we're celebrating Halloween Mad Money style by taking a bite of Hershey's to see if there's any hope of a sweet future for that one. Oh, by the way, someone tell me what's going on with Columbia Sportswear, please, after hitting a 52-week low. What should investors make of the apparel company's future? I'm going straight to the source for answers, so stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
This is a tough story. We keep hearing about a slowdown in restaurant spending, but we got a very different story from Restaurant Brands. That's the parent company of Burger King, Tim Hortons, Popeyes, Firehouse Subs. When reported yesterday morning, these guys delivered a terrific number. Healthy top and bottom line beat, better than expected same-store sales, up 4%. Their Tim Hortons Canada business, it just keeps humming. It is doing so well. Its international division that houses almost all the overseas operations, excluding China, fabulous. In response, the stock rallied 1.5%. But that was just the breaking of a 5-session losing streak. But today, then, it gave back the gains. Even though the quarter was good, the sellers just won't quit. I've got to ask, is this a buying opportunity? Let's take a close look at Patrick Doyle. He's the executive chairman of Restaurant Brands. He used to run Domino's Pizza, incredibly successful, 2010 through 2018. One of the greatest growth stories ever. Mr. Doyle, welcome back to Mad Money. And are you at the with Gordon Ramsay there and developing a new Wagyu burger?
He is not here making burgers today.
But you do have a menu that is innovative, and you got to tell us about it, because this is not the Burger King that we remember when we were growing up.
No, absolutely. Yeah, we've got a collaboration with him in the UK right now, doing a Wagyu burger. It's actually been doing incredibly well for us, and we're excited about it. And it's a way of bringing focus to our amazing flame grilled burgers. That's why people think about Burger King, but he's been fun to work with him. And the whole joke is, the burgers are not made by Gordon Ramsay.
But where are you now? Because it looks exciting.
I'm in Miami. I'm in the test kitchen for Burger King in Miami.
And are you doing a crispy onion dish? They've got some good ones coming from what I can tell.
Yeah. It's actually the whole platform of kind of these elevated Whoppers has been working everywhere for us. And we're excited about it. And it's, we're a burger chain at Burger King. We're focusing on great flame grilled beef burgers, and we're excited, and it's working. We're getting growth in the business.
All right. Well, I'm a fan, as I communicate to you when I go to one. I was in Frankfurt, food great. I told you about what was wrong, what was right. You fixed immediately.
We had some opportunities there.
Yes,
it's fixed,
yes.
I promise.
But the fact is that when I go to Europe and I want a meal that is an American meal, I go to you. But now this leads me to something that is disturbing. Pat, maybe you can help me. We have what I call thesis investing. This is the thesis. The American consumer being hurt, inflation's not so good, food stamps might be going away, divided government. Against it, that's the thesis. Against that is the reality, the empirical reality of how great your company is really doing. I'm trying to reconcile that. You were in the pizza business for a long time. You've seen ups and downs. How do we get people to distinguish between the guys who are doing well and the guys who aren't?
Yeah, well, you know what? It's interesting because, your new book talks about it. People need to be investors, not traders. If you're focused on that, if you're looking at a restaurant company, the way to think about whether a restaurant company is going to be a good investment is, are you convinced that they are delivering better food in cleaner, better looking restaurants with better service now than they were a year ago? And if you're continually doing that, and we're doing that across our businesses, in international, at Tim's in Canada, at Burger King, Popeyes, and Firehouse, I know that we're better today than we were a year ago, that's ultimately what creates growth. And that's ultimately then what generates earnings growth. And, so I think you're right. I mean, we talked about it in our call. Things got a little choppy again in October with the consumer. But first of all, that's just in the U.S. 70% of our cash flow comes from Canada and international. But in the U.S., look, it's going to pass. And, interest rates are coming down and, we're going to get it back. The consumer is going to come back. I'm confident. Exactly when, we don't know. And I think that's, as you talk about thesis investing, people are a little concerned about the consumer, but we're finding ways to get it done. We're taking a medium and long-term view on how we create value in all of our businesses. And it worked in the third quarter, and we're excited about what we're getting done to continue that growth.
Well, let's press that further. Thank you for mentioning the book. In the book, I talk about the concept of scale, something that you have helped me immeasurably in understanding. If there is inflation, say beef inflation, what are you going to do? If you're with the smaller guys, they are going to be buffeted by it. You have scale. And therefore, I didn't expect your prices to jump big, and they haven't.
No, they have not. They have not. And look, we've got to take care of our guests. And so, we've got peers out there that have taken prices up and down. And, we've got to have a consistent, great value for our consumers. It has put some pressure on restaurant level margins in the short term for our franchisees and for our corporate stores. But look, we're taking a long-term view. We want to build a great business. The way you build a great business is consumers know that they can come in, get great value on what they want to eat. It's not a good deal if it's not what they want, right? And so we're giving them good value across the menu, and that's ultimately what builds loyalty. That's what builds growth. And the way you give more value without just pulling the price lever is improve your food, improve your service, have better looking restaurants, all of those things, give them a better experience. If you have to take price, do it very judiciously, but don't force all of that, that up and down onto your guests.
Well, one last question. I continue to love Popeyes. Just love it. Had 2 good Popeyes within the last month. I don't understand the short-term underperformance. I say short-term because it's too good a brand to be kept down. Is there something I'm missing or something you're unhappy with?
Well, you know what? Just the pace of improvements there, it's improving. Experience is getting better. The food is the best in the industry. We just got to pick up the pace of the improvements. We do that, we're going to get the growth. The food is incredible. We just need to make sure that the whole experience matches that. We're getting improvements, just got to go a little faster.
All right, fair enough. Let's leave it at that. But I love, yes, the long-term investing versus this short-term trading will make it so you miss the next run in what is really a company that is so vastly improved. But if you go there, you know it. That's all I can tell you. If you go there, you know it. I want to thank you, Patrick Doyle, Executive Chairman of Restaurant Brands International QSR. Patrick, great to see you.
Thanks, Jim. You too.
Mad Money's back after the break.
Coming up, have investors gotten spooked by Hershey's latest performance? Or could lower cocoa prices mean the stock is in for a treat? Cramer's got his hand in the candy bowl. Next.
Tonight we celebrate Halloween, our great national secular holiday, by doing it the Mad Money way. By talking about the stock of Hershey. Not because it makes a huge percentage of the candy that you'll probably be giving out tonight, but because Halloween's supposed to be scary. And for the past 3 weeks, almost nothing's been more terrifying than being a Hershey shareholder. The stock has plunged from 196 at its highs earlier this month to 169 and change as of today. When the company reported yesterday morning, it wasn't enough to turn things around. Now, the stock actually tumbled from 175 to 171 yesterday. Before seeing to 169 today, this is baffling. Baffling. What is going on here? Why has this iconic candy maker become such a heinous stock? The truth is, Hershey's been struggling for the last 2.5 years. Now, I think a lot of that's largely because of the GLP-1 weight loss drugs that have hammered the entire packaged food industry. People just don't want to eat anything bigger than this when they're on those drugs. At the same time, they also struggle with sky-high cocoa prices, although that's gotten substantially better over the last 10 months. However, I got to tell you, I think the worst might be behind this one. Really, I do. This summer, Hershey hired a new CEO, a fellow by the name of Kirk Tanner. He previously ran Wendy's, but before that, he spent roughly 3 decades at PepsiCo. And he officially took over in mid-August. I remember flagging that to you that I thought was really great for Hershey, not for Wendy's. So far, though, he's had his work cut out for him. When Hershey reported in late July, right before Tanner took over, the company delivered a complicated quarter. This was a clear top and bottom line beat, but management cut their full-year earnings forecast because of the tariffs and the cost of the hedging program they put in place to manage the volatile price of cocoa. Interestingly, the stock spiked immediately on the news, reaching its highest level since last December when we were hearing ridiculous rumors, and I mean it, ridiculous, of a takeover from Mondelez. But then it came right back down. Since then, the action in Hershey's been choppy, turning to downright horrible over the past few weeks. I mean, sell. And that brings me to yesterday morning when Hershey reported again. Now, at first glance, I thought their numbers looked pretty darn good. Hershey posted net sales of $3.18 billion, which was up 6.5% year over year and above the $3.12 billion that Wall Street was looking for. Get this, organic sales growth came in at 6.2%. Almost all of which was driven by price increases. Still, that's a really good number for any packaged foods company, especially these days, especially, by the way, when the analysts were only looking for 3.6% organic growth. So what's the problem here? Well, on the other hand, Hershey's adjusted gross margin was 31.8%, and that was down a staggering 850 basis points year over year. 850 basis points? Reflecting, quote, here we go, higher commodity and tariff costs along with unfavorable mix, which more than offset net price realization, supply chain productivity, and transformation program savings, end quote. All right, that's obviously not ideal, but this was something everybody coming. I thought it was expected. In fact, the analysts only expected Hershey's gross margin to come in at 31.5%. Put it all together, and they earned $1.30 per share. Now, it is down 44% year over year, but again, much better than the $1.07 per share that Wall Street was anticipating. At the same time, Hershey raised its full-year forecast, but not by all that much. Management took up the low end of their earnings guidance by 9 cents, which is not much when you're projecting $5.90 to $6 per share. Given the size of the beat for the third quarter, that modest increase to the full-year forecast was seen as a bit of a disappointment. When you report a 23-cent earnings beat and you don't raise your full-year forecast outlook by more than 23 cents, well, that's practically a de facto guide down. Worse, on the conference call yesterday, management seemed pretty cautious. For one thing, they noted, and this is what I think's hurting, this Halloween season, it hasn't gone particularly well for Hershey. And they said it was starting slower than expected, thanks to warmer weather and a concentration of seasonal purchases in the final week, because guess what? That's what happens when Halloween falls on a Friday. The company also pointed out that it had some timing benefits in the third quarter that should be reversed in the current quarter. Oh, they also said the Mexican business isn't that good, but this is a company that really, Halloween matters a lot here, obviously. Looking forward to 2026, Hershey seems cautiously optimistic that things can get better, with an emphasis, by the way, on caution. I think management just doesn't want to stick their collective neck out for something they may not be able to deliver. They repeatedly emphasize that they're playing for the long term, not necessarily this current quarter, or even next year. I like that. Put it all together, and you can understand why Hershey stock has gotten pulverized after the past couple of sessions. I can't say that that's an unreasonable reaction to the quarter, even as the stock was already down hard going into the earnings. But, and this is a pretty big but, you might want to take the other side of the trade here. When you look at the quarter, those results were legitimately very good, much better than we've gotten used to from Hershey over the past few years. I actually appreciate management's cautious tone here. Remember, CEO Kirk Tanner's only been in charge for less than 3 months. This guy's a pro. Pros know you want to underpromise so that you can over-deliver UPOD in the future. I'm not alone in thinking that it's time maybe to get a little more constructive here. Overnight, analysts at Piper Sandler, they upgraded the stock from underweight to sell to neutral, citing reduced uncertainty. They also think that while cocoa prices could remain inflationary, that could moderate as 2026 comes in fully into focus. I agree with that, too. Honestly, if you don't have any position in Hershey and you want to diversify away from the pure tech like so many others are trying to do, yeah, it's tempting. Tempting to put on a small position here. With the stock down at the lowest level since early July, sure, Hershey still looks expensive, selling at 28 times this year's earnings estimates, nearly 25 times next year's. But if I'm right, that management's being deliberately cautious with its forecasting, then there's a good chance next year's numbers will come in higher than expected, making the stock a lot cheaper in retrospect after this big fall. So here's the bottom line. Hershey's been through a very difficult few weeks, coming on the heels of a tough couple of years. Their results have been muddled, including the quarter that was reported yesterday, as the new management team has only just taken over. In fact, they've been very conservative when talking about the future, but I like that. Frankly, I think that even if the stock hasn't bottomed yet, it's probably close to a bottom, although this one only works if you believe in Kirk Tanner's leadership. I'm a believer, though. I just wish it had been a happier Halloween and less of a trick and more of a treat for this peerless brand. Let's go to Bob in my home state of New Jersey. Bob.
Hey, Uncle Jim. Booyah.
Booyah, Bob. What's happening?
Frank, I finally got through to you. I bought some Target a while back when it was at its high, and I got rid of half of it. I just hung on to the other half, but it doesn't seem like it's doing anything, and I kind of figured maybe by Christmas it would hopefully go back. What do you think about that?
Well, it does have a new CEO, and we haven't seen the imprint yet. I will say this. These stocks are so out of favor that even if you buy the best of them, they're not working. A longer-term view would say that it's time to buy Walmart, or one that I talked about with Jeff Marks and I on the for the Charitable Trust, which is that Costco has come down so much that I think Costco is the way to go. I don't care so much about the yield. Target has a big one. I care about growth, and Costco's got that. That's the way to go. And let's go to James in Ohio. James.
James, I was just, it's an honor to speak with you today. Just like you, I'm a former resident of Philadelphia, and I want to give you a big-time broad and only booyah to you, brother.
Oh, come on, man. You know my mom is from about 10 blocks away. She's from Broad and Lindley. I mean, we got a stone's throw. What's going on?
James, I've been Costco hit an all-time high back in February, and I've been watching it like Burt Lancaster and Run Silent, Run Deep, things going down, down, down. And I don't know, is it a time to reduce my position, buy more, hold on? I know they have a new CEO now, and I don't know how that's affecting the operation. So I'd be interested in your take on that.
Okay, it's funny, and people have to understand, I actually do not know the questions ahead of time, and I just literally talked to a caller, and I was saying that I think that Costco is right. Now, when I say Costco is right, it sells at 45 times earnings. It typically is never cheap. I remember this from the old Berkshire days with the late Charlie Munger. Can you just start buying something because it seems at 45 times earnings? I think you can start a position. We own a long-standing position for the Charitable Trust. I don't like to violate my basis, but Costco is the best buy in the industry. I think it's been hurt by a piece in a major magazine about how maybe the best times are over. I just don't think that. So anyway, I agree. Costco's good, and go Birds. Look, Hershey's had a couple very rough years, but I think now might be an interesting time to start a position. It's down so much. Got a new CEO, Kirk Tanner, Total Pro. Much more Mad Money ahead, including my exclusive with Columbia Sportswear. Shares slipping after earnings to the lowest level since early 2016. Maybe investors are getting a buyer opportunity. Let's find out by going right to the CEO. And investors were spooked by Meta's earnings report. I think many are failing to see the forest through the trees. I'm going to break it down and give you a very opposite view of what everyone else is saying today. And then, of course, all your calls rapid fire tonight's edition of the Lightning Round. So stay with Cramer. When will the tough times stop for Columbia Sportswear? The apparel company, which you know as Columbia, Sorel, Prana, Mountain Hardwear, fabulous brands, struggled for a bit now. 4.5 years ago, Columbia was a $115 stock, and now it is under $50. After a nearly 4% drop today, its lowest level since 2016. Last night, Columbia reported a difficult quarter, better than expected revenue. Sizable earnings miss was driven by a big impairment charge. That honestly would have been fine, except management did give you some tough guidance for the current quarter, and that's the all-important holiday quarter. Look, I know this is a rough moment for all things apparel, for everybody. But is there any reason to believe the company can turn things around? I saw some green shoots in Europe. Let's check in with Tim Boyle. He's the chairman, president, and CEO of Columbia Sportswear to find out things. Mr. Boyle, welcome back to Mad Money.
Jim, it's great to be with you. Thank you.
Okay, so Tim, you heard my introduction. I'm seeing some green shoots in Europe. We have to talk about tariffs in a second, but tell me what's going on in terms of the stuff that is turning around, because I think there's reason to believe that at these levels, you got to believe.
I would agree with you 100%. You know, almost every market outside the U.S., in fact, it could be all of them, are doing very well. We have problems in the U.S. You know, the business of selling imported products in the U.S. with the tariffs is not insignificant. And but our business is based on products. You can see behind me one of our best-selling products, the Amaze Puff. It's probably the most expensive garments we've ever sold, and they're on fire right now. And so I think that's what we need to do. In addition, we need to invest much more heavily in marketing. And you'll probably have seen some of the work that we've done. It's a bit irreverent. It's focused on our former habitual product of showing, having fun in the outdoors and making fun of lots of things. But this is where I think the company's going to be growing and differentiating itself and improving.
But it is tough to put a lot of marketing dollars in when you have these tariffs, and you have chosen to keep prices reasonable for American consumers.
Yeah, it's it's an area that we have to be very cognizant of what's going on with our market. In 2024, we were the 81st largest duty payer in the United States. In fact, prior to Trump's first term, we were in the 40s. So our commodities are very heavily tariffed, and there's not much predictability, frankly, in the business. So we have to make sure that we've got a good balance sheet, which we do. We're strong, and we have to have a clean focus on where we're going. And it's proven itself in the markets outside the U.S. where the business is growing nicely.
Well, let's talk about outside U.S. because then we can kind of work back to see what happens when you do absorb things. Because this is organic. Tell me about, we've got boots in front of us. We have shoes and butters. I'm a big user of your product. These look like different new stuff. And just give us a sense of what's really what is really selling.
Well, the footwear business for us is quite good in Europe. So we have probably one of our biggest European customers in footwear. One of the biggest global customers for us for footwear is in Europe. And the business there is very good. It's grown both at the wholesale level and in our own DTC stores. And it's a real great opportunity for us. Additionally, China, which I believe ultimately will be the company's largest product geography, is growing well. And we have healthy businesses in Japan, in Central and South America. And the business is actually improving a lot in those markets. The U.S. is more challenging.
But let's talk about China, because at one time I thought that was going to be terrific, and then it kind of cooled as the consumer cooled, not as Colombia cooled. I am beginning to hear people tell me in several of our shows that the consumer is actually getting a little more liquid in China and starting to spend for stuff again after a prolonged period where they weren't buying things.
Yeah, and we've just started, as you know, the what they call the warm-up period for Double 11. It's starting off with a real nice range to it, and we expect that that's going to be a very strong performer for us. It's hard to parse into quarters in China, but I think over the long term, and certainly for this year, we expect to be growing nicely.
All right, now talk to me about prAna. You've got the impairment charge again. I mean, to me, it's such a natural brand. I am confused about what the game plan is there.
Well, we changed the management there, I want to say, within the last 18 months, and it's been a real positive. We've got great opportunities in front of the business. We're expanding it nicely into the south and southeast parts of the United States. It's been a California brand for so many years and focused on the West Coast. And we're getting some nice traction outside of those markets. So we believe strongly in it. We've got a great management team in prAna now, and I think we're poised to do very well with that brand.
All right, and then just give me just because I like people to know about Engineered for Whatever. I use your stuff for extreme outdoor stuff, which I do some things in, and it's anyone who's in the extreme, you look around, and this is what you see, your stuff. What should be looking for from the Engineered for Whatever campaign?
Well, I think if you look at the typical outdoor brand, they're poised themselves with beautiful outdoor scenery and lots of smiling people. And we've really focused on the outdoors is a collection of things, sometimes which are beautiful and pleasant, sometimes they're unpleasant. The weather always makes an impact, but we want to make sure that we have a point of differentiation when we're talking about our brand. And that's humor, a large dose of humor, and a large dose of tests we put our products through. And you may have seen some of the snowball tests, some of the snow plow tests that we're doing now. And these are areas where we can differentiate ourselves, and we're spending money behind these campaigns as well.
Well, it makes a lot of sense to me. I hope that Europe is the precursor of a big turn. I want to thank Tim Boyle, Chairman and CEO of Columbia Sportswear. Thank you, Tim, for coming on the show.
Thanks, Jim.
Mad Money's back after the break.
It was a dark and stormy night where Cramer's taking your calls. It's a Halloween lightning round. Next.
It is time. It's time for the light round. Chris Cramer, back for growing. Say the stock said about myself. So of course, had to tell my step first. Let us out. And then the lightning round is over. Are you ready, Ski? That's our light round. Let's go to Kent in Alabama. Kent.
Booyah, Jim. How are you?
I am doing well, Kent. How about you? Good to hear from you.
Outstanding. I'd like to start off saying I try to live by 1 Corinthians 10:31, so I give God the glory. But I have to praise you, Jim, for teaching me how to jump in the market. We're on track to retire early at 45 years old.
Wow.
And my question today is about SoundHound AI.
All right, now it's a pure spec. I like the fact that it's come back down from its high, but you need to know it does not make money. It's got to make money before I can get seriously behind it. And congratulations to you. Let's go to Bill in Massachusetts. Bill.
Jim, I love your insight. How you said, let's give Jassy a chance to prove himself, and you were absolutely right. You were pro Amazon all week. You seem to be right 95% of the time, Jim.
Thank you, man. I was out there on that one, I'll tell you.
Yeah, incredible. Good call. My question is about Nextracker.
Oh, man, we made that money in Nextracker for the Travel Trust, but then we didn't think that Shug had it in him to have a double. This company is a tremendous company. It still only sells at 24 times earnings. Parabolic move. I'd like to have it cool off a little bit, but wow. Congratulations to Dan Shugar, who really just did it. Let's bring in Danielle in Pennsylvania. Danielle.
Booyah, Jim, and happy 20 years. Hey, I've been learning so much years. What do you think about AT&T these days?
I'll tell you, there's a real scrum going on with AT&T and Verizon and T-Mobile. I don't want to get involved. It seems like there's just too many cross currents. Let's stay away from that. Let's go to Sam in Maryland. Sam.
Jim, QBTS. I love
All right, I see QBTS. Now, they do report this week. I actually see what they say because I think that Dr. Barats is very good. But this IBM is doing some amazing things in quantum, and I think the Trump people have been talking to them about the urgency of being ahead of the Chinese in quantum, and it's going to be IBM that leads the way. Let's go to Jay in New York. Jay.
Hey, Jim, how are you?
I am good. How are you, Jay?
I'm excellent. Club member, and been following you for a few years now, and I really appreciate all you do for the little guys.
Thank you very much. Check out How to Make Money in Any Market. That's my best solution for the little guy. How can I help you?
I bought it. I'm going on vacation in a couple weeks, and I can't wait to read it. My stock is it's the spec stock in my portfolio, Rocket Labs.
All right, I'm glad you said it's a spec stock, because otherwise I would not endorse it. I think it is a good spec, but it loses so much money, you got to be aware that who knows where it can only end up. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, has Wall Street misunderstood Meta's latest spending decisions? Cramer's breaking down the math behind the move. Next.
Wall Street can't seem to understand why Meta Platforms is spending such a staggering amount of money on the data center and everything connected to it. Now, this stock has dropped over 100 points since Mark Zuckerberg dropped the bomb. They don't spend whatever it takes. This year, they're on track to shell up maybe $70 to $72 billion. It's going to go to $100 billion next year, at least according to the current consensus estimates. And that's when the stock just went into oblivion. That was bad news. But wait a second. Let's think this through. Two things bothered people about all the AI spending. First, investors have gotten used to a more disciplined operation ever since Meta rolled out the year of efficiency in 2023. They're now reminded of the old profligate Mark Zuckerberg who spends like a drunken sailor. Second, he never really explained why they need all this money and need to spend it all. I mean, what is that all about? All right, I don't want to be presumptive, but let me fill you in on what I think Zuckerberg's doing here, and more important, why I think he is dead right and the stock's a buy now that he's pulled back so hard from its highs. First, let me just say that in How to Make Money in Any Market, I wrote with great respect about Meta. We bought Facebook for the Travel Trust way back after its busted IPO, and we haven't wavered our support for Mark Zuckerberg since. He's an uber competitive genius with a stellar track record, so I would never bet against this man. My belief is that Zuckerberg's spending so aggressively because he wants to maintain, improve, and grow his social initiatives worldwide. And he doesn't want to lose his dominance in that incredibly lucrative business. And Meta could easily lose its dominance if it doesn't continue to innovate and astound and, yes, spend. Who could possibly challenge them? How about the private outfit known as OpenAI, which seems to want to challenge all these hyperscalers with some innovation and some gusto? If Meta doesn't spend heavily, I think it is reasonable to expect OpenAI will come after them. Zuckerberg recognizes the threat to the Meta kingdom, and he knows he can blunt it by making it real clear that you'd have to be a fool to try to bet against and come in and compete against his company. Why not go after the other hyperscalers that aren't defending themselves as aggressively? That's smart. It's kind of like the story of the two hikers being chased by the bear, right? To escape, you don't need to outrun the bear. You only need to outrun the other hiker. In this case, the other hikers are Amazon for web services and retail, Alphabet for search and YouTube, and Microsoft for enterprise software. If this spending can keep out OpenAI and its compadres, then I think it's a small price to pay, actually. Right now, Wall Street clearly disagrees with me, given that Meta's lost about $250 billion in market capitalization. But as I see it, it would be irresponsible of Zuckerberg not to invest in his vast network of properties. Remember, he's not burning money in some gigantic chimney. He's actually putting it to work. He's spending it where he'll get terrific returns, and I have total faith in that. The market disagrees with me, clearly, but I don't have enough fingers and toes to count how many times the market has been wrong about Zuckerberg and Meta. On a larger issue, people keep wanting to equate this era with 2000. Back then, anything you bought to maintain or improve your site was almost immediately worthless a few months after it was implemented because of breakneck innovation. Now in the case of NVIDIA, where the big spend is, you are seeing some very long-lived assets. We need to stop sweating that program. The genius of Zuckerberg is that as long as he spends enough to fend off the competition, Meta can remain the ultimate social media platform for years to come. Call me a buyer. I like to say there's always a bull market somewhere. I promise I'll find it just for you right here on Made Money. I'm Jim Cramer. I'm going to see you Monday.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.